Okay, welcome back to the deep dive. Today we're diving into the essential world of business finance.
Yes, and specifically, we're looking at part 2 of Unit 3.
That's the costs and break-in analysis part.
Exactly. And our focus today, our mission, if you like, is Chapter 27, Costs.
Right. And honestly, understanding this chapter is it's the absolute foundation, isn't it?
It really is.
Yeah.
It's how businesses start making sense of where all the money goes, categorizing those expenses.
Absolutely. Because before you can even think about profit or loss or comparing how well a business is doing,
You have to get a grip on the different kinds of costs they face.
it's like learning the alphabet before you read a book, like
Okay.
we said. Getting these basics from Chapter 27 sorted is just crucial for everything that comes later.
Yeah, like when you get to financial documents, say the Statement of Comprehensive Income in Chapter 29, you'll see different cost categories there, and this chapter helps you understand them.
So think of this deep dive as a focused session. We want to really study and revise these core ideas together.
We'll be pulling out the key points, focusing on the main titles, those bold blue subtitles you see in the source material, and the really important bullet points. Definitions, examples, that sort of thing.
And just a quick heads up, we won't be walking through complex numerical activities or detailed case studies step by step.
No, not in this format. We'll definitely talk about the examples and the ideas behind graphs to make the concepts clear.
But the goal here is understanding the principles, not doing specific sums from the book right now.
And this is super relevant if you're an IGCSE business student. Maybe you're even tackling this in English as an additional language.
Yeah, we're aiming for real clarity on these building blocks.
And don't forget, as you work through Unit 3, including Chapter 27, there are more resources out there.
That's right. Check out www.igcc-business.weebly.com. We'll mention it again later, but it's a good one to bookmark.
Okay, so let's jump in. Why do businesses even have costs? Where do they come from?
Well, they have to do stuff, right? Make things, provide services, and doing that uses resources.
Exactly. You need things like raw materials, people, labor, energy, machines, maybe a building.
We're paying for all that stuff. Well, that's where costs come from. It's unavoidable when you set up and run a business.
The source material uses that great example of making tires. Think about it. You need rubber, fabrics, steel,
Machinery, a factory.
people to run it all, energy. Every single input costs money.
And here's the crucial bit, the main idea in this chapter. Not all those costs behave the same way.
Right. Some change depending on how much you produce, how much output there is.
And others, they just stay the same, regardless.
Which brings us nicely to our first big category, fixed costs.
Okay, so what makes a cost fixed?
Well, the definition is key. A fixed cost is a cost that does not vary with the level of output.
Meaning it stays the same whether you make a lot or a little.
Exactly, within a certain time frame anyway. And, this is important, they stay the same even if your output drops to zero.
Wow. Okay, so even if the factory is idle, you're still paying these.
Correct. Think of them as commitments. The classic example is rent for your building.
Right. The landlord wants their money whether you sold one thing or a million things this month.
Precisely. Or business rates, those property taxes some businesses pay.
Okay. Rent, rates. What else?
Salaries for your permanent staff, like managers or admin people, whose pay isn't directly tied to how many widgets you make.
Insurance premiums.
Yep, usually a set amount. Interest payments on loans. The bank typically wants its scheduled payment regardless of your production levels right now.
The source also mentions things like R&D. Big advertising campaigns sometimes fit here too.
Yeah, because the spending decision is often made irrespective of immediate output fluctuations. These are sometimes called overheads.
Overheads. Okay. They're sort of the background costs of just being in business.
That's a good way to put it. Let's use that Frampton training example from the source to picture it. They run training courses.
And their fixed costs are $40,000 a year.
Right. So if you drew a graph, the fixed cost line would just be flat, horizontal at $40,000.
Doesn't matter if they run 100 courses, 150, 200 of
Yeah.
It stays at $40,000.
Exactly. It's the cost of keeping the lights on, essentially, for that year, before you even consider the cost per course.
Okay, got it. Fixed costs, stubborn, don't change with output. So what about the ones that do change?
Those are your variable costs.
And the definition.
Costs that change when output levels change.
So the complete opposite of fixed costs, they're flexible.
Totally flexible. Make more, variable costs go up. Make less, they go down.
And if you make nothing.
In theory, variable costs should be zero.
Okay, examples. What are typical variable costs?
Raw materials is the classic one. Making shoes. The more shoes, the more leather, laces, glue you need.
So the total material cost goes up. Makes sense.
Packaging is another good one. Sell more items. You need more boxes or bags.
Fuel?
Yeah, especially if it's for, say, delivery trucks or
Hmm.
machines that only run when you're producing.
And what about labor? Some salaries were fixed.
Right, but some labor is variable. Think about workers paid by the hour, only for the hours they work on production. Or piece rate workers, paid per item they make.
Ah, okay. So their wages go up and down with production volume.
Exactly. Let's look at Frampton Training again. Their variable cost is $500 per course.
So for every single course they add, it costs them an extra $500.
Precisely. So if they run 100 courses, that's 100 times $500.
$50,000 in variable costs.
Right. And if they run 150 courses, it's 150 times $500.
$75,000. Okay, I see. The total variable cost increases directly with the number of courses.
And the graph for variable costs shows that perfectly it starts at 0 and slopes upwards. More output, higher variable cost.
So if I think about my imaginary bakery again, the rent is fixed, but the flour, sugar, eggs, those are variable.
Perfect analogy. Bake more loaves, you buy more flour. Bake fewer, you buy less. Rent stays the same either way.
That distinction feels really important for managing a business.
Oh, it's absolutely critical. Knowing which costs are fixed and which are variable helps managers predict how total costs will behave as output changes. It informs decisions about pricing, production levels, cost control, everything really.
Okay, so we have fixed costs,
Right.
steady, and variable costs change with output. What happens when we put them together?
That gives us our total costs.
And that's just adding them up.
Yep, simple as that. Total cost, TC, is the sum of fixed costs, FC, plus variable costs, VC.
TC equals FC plus VC.
Got it. It represents the entire cost the business incurs to produce a specific amount in a given period.
So back to Frampton Training running 100 courses, their fixed costs were $40,000.
And their variable costs for those 100 courses were $50,000.
So total cost running 100 courses that year.
And on a graph, the total cost line wouldn't start at 0, would it?
No, that's right. It starts up at the level of the fixed cost $40,000 in this case because you have those costs even with zero output. And then it slopes upwards parallel to the variable cost line.
Precisely. It shows total costs increasing as output increases, starting from that fixed cost base.
Okay, so knowing total cost is vital. But sometimes businesses want to know the cost per item, right?
Yes, that's often very useful, and that's where average costs come in.
So average cost, AC, is?
It's the cost of producing a single unit of output, on average. You find it by taking the total cost and dividing it by the number of units you produced.
So the formula is average cost, total cost quantity produced.
That's the one.
Let's use Frampton again. Total cost for 100 courses was $90,000,
So the average cost per course is $90,000 divided by 100 courses.
which is $900 per course.
Right. It means on average, each of those 100 courses cost them $900 to put on. This helps them think about efficiency and pricing.
Okay, costs covered, fixed, variable, total, average. But businesses aren't just about spending money, they need to make it too.
Absolutely. Money coming in.
Yeah.
And that brings us to total revenue. Total revenue, TR, is simply the total amount of money a business generates from selling its output, goods or services.
The income from sales. How's it calculated?
It's the price you sell each item for, multiplied by the number of items you actually sell.
So total revenue equals price X quantity.
Exactly. Let's say Frampton Training sells each course for $1,500.
And they sold those 100 courses we keep talking about.
Their total revenue is $1,500 per course times 100 courses.
That's $150,000.
Correct. $150,000 flowing into the business from those sales.
Okay, so now we have the money going out, total costs, and the money coming in, total revenue,
And why do businesses track both so carefully?
to see if they're actually making money, to calculate the profit, or sometimes a loss.
Yes. Profit is the big one for most businesses, financially speaking. It's the difference between what they earned, total revenue, and what they spent, total cost.
And that crucial formula is profit, total revenue, total cost.
Got to know that one. So let's finish the Frampton example. Their total revenue for 100 courses was $150,000.
And their total cost for those 100 courses was $90,000.
So profit equals $150,000 minus $90,000.
Which equals $60,000.
That $60,000 is their profit. The money left over after all costs are covered for that activity level.
And if the costs were more than the revenue,
Then they've made a loss. The calculation would give you a negative number. Understanding profit or loss is like the final score on the business's financial performance for that period.
Right. Now, this leads to a really critical reminder, something highlighted in the source material.
Yes, very important.
These formulas we've just discussed, total cost, average cost, total revenue, profit,
They seem straightforward, but
you generally won't be given them in an exam situation.
that's right. You absolutely need to memorize them, know what each part means, how they fit together.
PCFC plus VC. AC equals TCQ, TR, PXQ, profit equals 2XE.
Yep, drill them. Practice using them. They're the basic tools you need for analyzing business finance.
Okay, shall we do a quick check, a mini quiz, just to see if these ideas are sinking in?
Good idea. Fire away.
Okay, question 1. Think about a local coffee shop. Which of these is most likely a fixed cost for them? A, the cost of the coffee beans they use, or B, the monthly rent they pay for the shop space?
Fixed cost doesn't change with output.
Output here being cups of coffee sold.
Okay. Well, the more coffee they sell, the more beans they use. That cost changes. That sounds variable.
Right.
The rent, though, they probably pay the same amount each month whether they sell 10 coffees or 1,000 coffees.
No.
So B, the monthly rent must be the fixed cost.
Excellent. Rent is fixed. Coffee beans are variable. Perfect.
Okay, my turn. Let's say a business sells 200 handmade scarves at 25 pounds each. Their total cost to make and sell these scarves were 3,500 pounds. How would you calculate their total revenue?
Total revenue. Okay, that's price times quantity.
Yeah.
So the price is 25 pounds and the quantity is 200 scarves. 25 times 200. That's 5,000 pounds.
Spot on. Total revenue is 5,000 pounds.
Okay, and sticking with those scarves, what was their profit?
Profit formula time.
Profit, total revenue, total cost. We just found total revenue was 5,000 pounds.
And the total cost was given as 3,500 pounds.
Right. So profit equals 5,000 pounds, 3,500 pounds. That leaves 1,500 pounds profit.
Fantastic. You've got it. See, applying those formulas isn't so bad once you know them.
Yeah, that helps lock them in. And really, understanding how to split costs into fixed and variable, then calculating totals, averages, revenue, and profit. It just underpins everything, doesn't it?
It really does. It's the language of business finance. You needed to understand financial health, performance, and make sense of those financial statements later on.
So thinking about all this fixed costs hanging around, variable costs, moving with activity, putting it all together for total cost, comparing that to revenue to find the profit. Here's something to chew on. Final thought, maybe.
Go on.
How could a manager use this knowledge, specifically the difference between fixed and variable costs, to make better decisions? Like, how could it help them decide about, say, cutting prices to sell more? Or maybe investing in a new machine that might raise fixed costs but lower variable costs per unit?
That's a great question. Because analyzing costs like this isn't just for accountants. It's a real strategic tool. It helps you understand the impact of decisions on your profit.
Yeah, it's about seeing how changes in what you do or how much you sell affect the bottom line.
Exactly. So keep mulling that over. How does understanding cost behavior translate into smarter business choices?
And don't forget, for more resources, practice questions, and revision materials on Unit 3 Business Finance, including Chapter 27 on costs.
Head over to www.igcec-business.weebly.com.
Keep practicing those definitions, know those formulas inside out.
And try spotting fixed and variable costs in businesses you see every day. It really helps make it real.
We hope this deep dive has helped you revise and understand the crucial topic of business costs.
Definitely. Until next time, keep digging into business.